So that is why now let's look at the stochastic trading features on the S&P 500 futures, gold and the US dollar. So as for the S&P 500, looking at this instrument historical price movement, it's visible that the price decline doesn't always follow a stochastic move to the overbought area. Vice versa, when the indicator is in the oversold zone, it's more likely the market will rise soon. So the signals of a bullish reversal work well when the market is a temporary oversold in the uptrend. Signs of a bullish correction will likely work if the market entered an overbought area in the downtrend. And so, when trading gold, it's not recommended to use overbought or oversold signals even with a line crossing. When the market is a temporary oversold in the uptrend, signals on a bullish reversal usually don't work. Meanwhile, it's likely a bearish reversal works when the market is a temporary overbought in a downtrend. So now in a case of the US dollar, it often continues moving following the momentum when curves enter overbought or oversold zones. Therefore, you should enter the market when there is a price reversal. So the stochastic strategy isn't useful for the US dollar if it's based on fixing overbought conditions during an uptrend and oversold ones during a downtrend. So the stochastic oscillator is a high frequency indicator that can generate false signals, especially in a strong directional movement. Let's consider the most popular combinations using any type of a stochastic oscillator with other tools, such as the stochastic RSI. So first, let's discuss moving averages, of course. This is one of the simplest trend strategies that allow traders to get good results. So to define a long-term trend, we will use the daily time frame, while entry and exit points will be determined on the hourly one. So first, we add 3 exponential moving averages with periods of 50, 100 and 200 bars. We use a stochastic oscillator to find the entry level. And so the recommended settings are for the periods of stochastic is 14, 3 and 3. And as for the overbought and oversold levels, 90% and 10. So, conditions for a long trade. There is a long-term upward trend on the daily chart. The price moves up and it is above the 50 EMA, while the EMA 50 is above EMA 100, which in turn is above EMA 200. On the hourly chart, the oscillator crosses 10%. So, as for the conditions for a short trade, there is a long-term downward trend on the daily chart. The price moves down and is below the 50 EMA, while the EMA 50 is below EMA 100 and EMA 100 is below EMA 200. On the hourly chart, of course, the oscillator must cross the 90%. So, place a stop loss slightly below the local extreme. A profit can be fixed by a take profit that is 2 times bigger than the stop loss, or by a trailing stop loss when you wait for the price to return to 50 period EMA. So if the most recent closing price is below it, you should fix profit. In another version of the stochastic strategy, you should wait for the stochastic to enter overbought or oversold areas to fix profit. To make it clear, look at this example. We observe a long-term uptrend on the daily chart. Therefore, we will only open long trades while we monitor the most recent closing price. With the hourly time frame, we wait until the curve crosses 10%, which is the blue circle. We enter the market at the close of the breakout bar where the lowest price is located, marked with the blue line. A stop loss is placed slightly below the minimum, which is the red line. And so, during the price movement, the stop loss first moves to the break-even and then to the profitable zone. So we close the trade when the stochastic indicator comes closer to the 90% line, where we compare it with the most recent closing price, which is marked with the green line. And so, all trend strategies are used to open positions in the current trend or fix profit when the trend changes. Still, an entry point is considered a weak spot. A stochastic oscillator can solve this issue. A combination of a stochastic oscillator with any trend indicator can provide good results and avoid false signals. In this regard, it's essential to follow several rules. So, first, determine a trend on higher timeframes. Secondly, don't open trades against the trend. Third point, use percentage K and percentage D cross in the overbought and oversold areas to define entry point. Then try to use a stochastic oscillator with your favorite trend indicator. So follow these three simple rules and you will be surprised by the result, I can guarantee. Next is with the usage of BB, because Bollinger Bands indicator is the leading tool in this strategy, while the stochastic oscillator will be used as a signal filter. Note, this strategy is intra-channel, so the trade occurs within Bollinger Bands. The indicator settings are standard, the moving average period is 20 candles, and the standard deviation multiplier is 2. We should also add the stochastic oscillator with 5, 3 and 3 parameters. And so, conditions for a long trade. Firstly, a bar crosses or at least touches the bottom line of the Bollinger Bands. Then the percentage K line crosses the percentage D line and bottom up below 20%. And then we can enter the market at the opening of the next candle after the signaling one. So, conditions for a sell trade. A bar crosses or at least touches the upper boundary of the Bollinger Bands, then the percentage K line crosses the percentage D line upside down above the 80% level. And so enter the market at an opening of the candle that follows the signaling one. A stop loss is of course set with a small shift from the extreme point of the breakout bar. And the ideal take profit is at the opposite band of the Bollinger indicator. So when working with a buy trade, it should be placed at the upper boundary, during a sell trade at the bottom band. So let's take a look at the strategy example. So the blue circle points to the moment when the bar touches the bottom line. In the same area, the percentage K crosses the percentage D from the bottom, thus confirming the primary signal. So we enter the market at the opening of the next candle, which is marked with the blue line, and it is the level of 1.17444. So the stop loss is set slightly below the minimum of the touch candle, and the take profit is at the upper boundary, and this was the level of 1.17808. And so in a while the price declines, almost touching the stop loss level, but it turns around and surges. So the trade is closed at the take profit level, which is marked with a red circle. And the final profit was 364 points or 36.4 pips. So now maybe let's compare stochastic and RSI. So the stochastic oscillator and the relative strength index, the RSI, are often compared. So this is partly due to the fact that they are both among the most popular technical analysis tools. Many traders widely use both indicators, and still, besides their popularity, we have many other similarities. So, first, they are oscillators. Second, they reflect the speed of the price change. Third, they provide the same signals, overbought and oversold zones, and bearish and bullish divergence or convergence. So, they are flexible, useful on any time frame and of any market. And meanwhile, they have also many differences. First one is the settings. The RSI has only one setting, and it's a period of the moving average. The stochastic has 4 parameters. Next, there are unique signals. Traders widely use a cross of the stochastic oscillator, percentage K and percentage D curves. The RSI doesn't have a smoothing moving average. However, the relative strength index is used to set support and resistance levels, and we can apply graphical analysis for this indicator. Standard overbought and oversold levels for stochastic are 80-20, for the RSI are 70-30. So I would not advise beginner traders to combine the RSI and stochastic oscillator. Both tools are based on the measure of the price dynamics, and that's why signals won't vary a lot. If you use them together, they will likely confuse you due to the high frequency of alerts and fake signals. So nevertheless, we can't compare the stochastic and RSI. Each of them is unique and valuable for traders. So we can simply say that there are no 100% accurate instruments of technical analysis, and the stochastic indicator confirms this as well. So it provides plenty of signals, but some of them, of course, are false. And you can minimize this limitation using 2 methods. First, you need to find practical settings for the particular trading instrument and the time frame. Then, of course, you need to filter stochastic signals with other tools of technical analysis. And reversal candlestick pattern and chart patterns such as triangles and head and shoulders are the best for signal confirmation, and it's highly recommended to implement a stochastic oscillator with other trend indicators. It helps avoid numerous fake signals. So take your time to learn more about the trading strategy of stochastic with Bollinger Bands, for example. The stochastic oscillator is an excellent tool due to the number of adjustable parameters and the simplicity of the supplied signals. So you should practice it to get high quality trading alerts and locate the highest and lowest price in order to compare. So despite how long ago it was invented, the stochastic oscillator is a perfect supplement of any strategy today. And on that note, I could end this video, and simultaneously is the end of the materials about stochastic for now, at least. Remember, practice, practice, practice. Thank you guys for watching, and I'll see you in the next one.